So today we're talking about a full cycle deal case study, and we'll kind of talk about the case study itself. We'll also talk about making case studies, the importance of case studies, and how to best present information to potential investors. With case studies and your track record obviously being an extremely critical component to due diligence when it comes to sponsor due diligence. So we'll be talking about specifically Verandas at Bear Creek, which is a property that we sold last year in Houston. We held the property for about 3 years, and it was a very successful deal for us. So if you want to follow along with the materials, you can actually access them at LSCRE.com. So that is actually our due diligence link that we share with new potential investors to give them everything they want in one place, which is really impressive, and people really like it. And it helps us, it saves us a ton of time as well, because we don't have to go and scramble for due diligence materials every time someone is asking us for certain things like sample reporting or sample legal docs or our company presentation, things like that. So if that's interesting to you, have a look, lscdd.com. I put that in the chat. As you're navigating that Dropbox, you can see that the number 3 folder we have is case studies. And the second case study we have is Verandas at Bear Creek, which is what we're going to be talking about today. So I'll go ahead and share my screen. And as always, if you guys have questions, feel free to put them in the chat throughout. And then also, if you are brave, you can unmute yourself and jump into the conversation as well. That is always welcomed to make this as interactive and valuable as possible. So diving into the makeup of the case study folder here, all right, just to recap, we're in the data room, case studies, and then this case study in particular. So Amir, you might have joined just before I put it in. I'll put it in again. It's lscdd.com for the Dropbox link. So the makeup of this folder is the case study, first and foremost, which we'll dive into in detail, and then the quarterly reports, which if we look at, these are just all the quarterly reports that we have for the deal. We didn't start actually producing quarterly reports from the very beginning of this deal. So it just shows you how much we've grown and improved our process. And in a second, I'll show you the pitch deck that we had in 2019, and I'll be very embarrassed to show you that. But yeah, so we have these quarterly reports, which is super helpful for an investor to review, because it shows them the progress of the deal over time, how we're handling challenges that may have come up. Obviously, this period of time here, all through COVID, would be a very interesting time to review for an investor to see, okay, well, in this quarterly report, what were we talking about? What did we have to say? And how did we handle the effects to our operations? And also, just to look at that report, this report is much uglier than what we are producing these days. So it just shows you we're constantly improving. So I'd love to, if there's time, show you some of our newer reporting, newer pitch decks, newer stuff. So case studies in the future will only get better and better. And yes, we will be recording and sharing this after. So if you are here, that means you registered for this, and that means you'll automatically get the replay email shortly after today's call. So yeah, so we won't spend too much time diving into the quarterly reports unless there's interest in that. We could definitely share those. I would rather probably share with you a more recent quarterly report, just because it's a lot nicer these days. But just showing you the makeup of the case study folder for the purposes of someone on this call interested in producing something similar, which I think is valuable, because it's super compelling to be able to share stuff like this for investors, because something that we implement, and I'm not sure if it was, let's actually take a look at yeah, so you can see we started to improve the reports here. This is kind of more similar to our newer quarterly report template. You could see the financial results section. We do benchmark every single quarter's performance to the underwriting, as well as to our management budget, which is here. and also investment to date underwriting, investment to date actual. So these are our underwritten numbers, and then these are the actual. So it's good to compare those to keep yourself honest and accountable, because obviously investors are investing in part based on the projections that you're providing to them at the time of acquisition. And you don't just close the deal and then throw those assumptions away, right? There should be some accountability there. So something that we could spend more time on is that quarterly report there. And then finally, in this case study folder, it's good to, of course, have the underwriting and the pitch deck. So the pitch deck is obviously the investment summary. This is what investors reviewed when making their investment decision at the time of acquisition. So that's good to be able to show investors the business plan of the deal and how that actually corresponds to the actual results of the deal through the case study. And then, of course, the underwriting, which is the underwriting, right? Transparency, showing investors the numbers, all that. That's very important. So those are the makeup of the case study folder, right? Not just a simple case study document. Hopefully that's helpful, and hopefully that makes sense. So let's dive in to the case study. And if this is small, I think I'll just make it a little bigger. So Verandas at Bear Creek, it was a 160 unit property in Northwest Houston that we acquired in June of 2019. And we bought the deal with somewhat of a unique plan. It wasn't your traditional value add plan where we were going to go in, renovate units, and bump the rents $100 or $200. The interiors were in solid condition. They were recently renovated by the seller. And the interesting opportunity with the property was that it was actually underperforming. It was around 80% occupied. And we really felt there was no reason for that. So with the confidence of our management team, we felt comfortable acquiring the property, and without really spending too much on CapEx, to be able to push occupancy into the mid-90s. We looked around at all the properties nearby, and we saw that they were in the mid-90s occupancy, and we felt that we could push the property to do the same. So that was looking back, it was a really great find and a really great opportunity that we were able to uncover and see that there was value in this deal, where most of the market saw this deal as a fully renovated asset with no upside. And they didn't like the deal because it was underperforming, and you couldn't get agency financing. And this was at a time in early 2019 when people were more so leaning towards agency debt rather than bridge. In 2021 and early 2022, investors would have probably had an easier time with a deal like this because they would have just financed it with bridge, bought it, and went away with it. But for us, we actually had a competitive advantage because a lot of people were turned off by this deal because of the lower occupancy and because the agency debt was not available. So we pursued a bridge loan, and that's how we made the acquisition happen. And that's in part led to our ability to acquire the property at a very favorable basis of $11.5 million, or just under $72,000 per unit.
Hey, Rob, I got a quick question for you, if you don't mind me interrupting here. How'd you guys find this deal, or where are you guys finding the majority of your deals?
So this deal was originally on the market through a smaller brokerage in Houston. And then because of the things I mentioned, that it wasn't necessarily a straightforward deal from an occupancy perspective, and from the fact that there wasn't a straightforward value add proposition, the deal didn't trade. The seller had a higher pricing expectation, and for all those reasons, they weren't able to find a buyer. So after multiple attempts to market it, it kind of stalled out, and then we kept in touch with the broker, and we had our price, and we kind of kept in. That's why it's always valuable to just put in your honest offer, not necessarily a lowball offer, but just your honest offer, because you never know when they're going to pick up the phone and call you back and say, you know what, your offer is now in play. So that's exactly what we did. We had put in our offer, expressed our interest, shown ourselves as a legitimate buyer. And so sometime later, I don't remember the exact timeline, but 6 or 9 months later, the deal came back to us, and we had the opportunity to make a deal. So that's how we were able to strike on this deal. And in general, these days, really the vast majority of our deal flow comes from the broker networks, whether it be on market or off market. And we're not afraid to compete in an on market situation. But, having a story is always beneficial.
Thank you.
So for the business plan, we had a $500,000 budget contemplated, which was pretty small, only about $3,000 per unit. And we ended up spending $518,000. So we pretty much kept up with the business plan. We went slightly over budget, I would say mostly due to some unexpected plumbing expenses. But all in all, the CapEx went to plan and was very successful. What we did as far as the interiors was we put backsplashes into the kitchen, which doesn't cost much. And we were even able to do that while tenants were still occupying the unit. But just that simple fact of adding the backsplash made the property competitive to the comp set, and it allowed us to push rents while also reaching at one point 100% occupancy within the first 12 months of ownership. So we took it from 80% occupancy all the way to 100% in less than 12 months. And we were also able to push rents by about $50, which was just due to managing the property better marketing, and adding in the backsplash in the kitchen. So before we go much further, I'll just highlight the summary at the top. So we raised a total of $3.4 million of equity. We had $9.3 million of debt. So the total capitalization of 12.7. Obviously, the delta between the purchase price and the total capitalization was the renovation budget and closing costs and reserves. So we had projected a 19.4% project level IRR. That's not net to investors. Net to investor was somewhere around 16%. So we had projected a 19.4 gross IRR with an actual result of 37% gross IRR and about a 30% net IRR to investors over a nearly 3-year hold period. So just shy of 3 years. We had projected originally a 60-month hold period or a 5-year hold period. And one thing you'll notice here that is weird and something that we did this time and won't do ever again, most likely, is we had factored in a refi into this deal. And that actually is, as many of you probably know, not very common, and some people consider it to be a no-no. I consider it kind of to be a no-no. I don't like when people factor in refinances into their underwriting, just because it more often than not looks aggressive and complicates your underwriting. And so simpler is usually better. So that's why you'll see here, even though we had underwritten a strong return over a 5-year period, we weren't getting to a 2x equity multiple. And that's because of the projected refi, right? And so when you refi a bunch of money out of a deal, those dollars are no longer working for you, right? You refied them out of the deal. So you might have a stronger IRR. You're boosting your IRR because you're making more money sooner through the refi, but you're actually reducing your equity multiple. Doesn't mean refis are bad. Refis are fantastic, but just for numbers' sake, specifically the equity multiple, that's what happens when you project a refi. So, and projecting this refi and the fact that this was our second acquisition ever, and the fact that this is kind of a not down the fairway business plan where we were basically just saying, hey, we can raise rents and bring up occupancy without really doing a value add plan just because we're good managers and we think the seller is bad. All those factors made for a very difficult capital raise. We really struggled to raise capital. And I think, again, it was for those reasons. We had factored in a refi, which people didn't like. It was our second deal. And it was not a straightforward business plan from kind of the usual value add story. So
I have a quick question on that real quickly.
Sure.
Rob, on taking that from 80% to 100% occupied, like, would you mind like double clicking into that? Like, what did you just work with a better agent? What was the happy path that led to 100%?
Just better marketing efforts. So there's a lot of properties in this little pocket. And so just more aggressively marketing to drive-by traffic and leasing best practices in the office. It was, I mean, definitely our team did a fantastic job, but it was less about doing amazing things and more about just fixing the mistakes of the seller. The seller was more of an absent owner in that they had renovated the asset and just wanted to get out. They weren't really focused on management. They were just more so focused on their renovation program, which they had implemented, and then they had wanted to get out. And because they had struggled to sell the deal for almost a year, they had sale fatigue, they had management fatigue, and the property's performance just continued to get worse and worse over time. And we just had the confidence that not necessarily that we would be the best managers in the world, but that we could certainly bring the property to perform at the market level, right? We weren't saying, hey, the market's here, we're going to go here. The property was here, and we thought we could bring it to market. Okay, so
thank you.
Yeah, no worries. So as you can see, the actual results being a 37% gross IRR, an equity multiple over 2x in under 5 years, right? It's equity multiple really is only relevant when you know the hold period. And then average cash on cash was pretty much right on target of 8.5%. So that's very cool to see, especially on the fact that we had a bridge loan. The other thing to mention on this deal, and I think this case study does reference it later, is the fact that we sold this deal. Let me just remind myself. So we sold this deal, I believe, in April of 2022. Yes. So we were prepared to sell actually much sooner. We had implemented the business plan, and we had really realized the success of the business plan much sooner. But obviously, as we know, COVID happened, and we were in our bridge loan at the time when COVID hit. And so it was a very big concern for us to be on a bridge loan because having short-term debt like that, floating rate, higher risk, was not something that we felt comfortable with given the economic uncertainties of March, April 2020. So we worked towards a refi in October of 2020. So it finally closed in 2020, but we were working on it much before then, of course, as not necessarily a win, but as a way to reduce risk. We wanted to take the bridge loan risk off the table. So all of the bridge loans in our portfolio at the time of COVID, we refinanced out of them. So we had no bridge loans because we were just concerned at that time of, our tenants going to pay their rent? Are the capital markets going to fall apart? So getting into long-term 10-year agency debt, which also the Fannie Mae and Freddie Mac were offering forbearance, that was something that we felt was extremely prudent. And so we refied in October of 2020 at an appraised value of $14.7 million or $92,000 per unit. And we returned 36% of investors' original capital. So it was a win, but we would have done even better with a sale, as you could understand. So the reason why is with the refi, then from there and the COVID disruption, we ended up holding the property for longer, which is fine. You know, the property continued to grow in value and the property continued to perform and provide strong cash flow. But if you want to show really strong IRRs and really impress investors and have a 40, 50, 60% IRR, those numbers are usually only possible when you shorten the hold period to 2 years or less. When you have an 18-month hold or a 24-month hold, that's where you can have really big IRR numbers. So you could see with the sale that eventually happened in April of 2022, it took us an extra couple years almost to sell the property. However, we did sell for a much higher number than the appraised value in 2020. So $17.5 million sale rather than a $14.7 million sale. And that's obviously because the Fed lowered rates in 2020 and this big reflation out of COVID. We saw asset values go way up, rents went up due to inflation, and cap rates, meanwhile, came down because interest rates went to zero. So it was a really great time to own real estate, and we definitely benefited from that. So that's kind of the story arc of our deal here and how we got to this exit. So I'm going to dive into a bit more specifics now on the deal and just share with you a little bit more about what we saw when we bought the property. So things that attracted us to the Bear.
Rob?
Yeah, go ahead.
Hey, just specifics before you dive into that. I'm curious, you said it was a floating rate bridge, but I'm curious what the actual terms on that, where you felt comfortable enough to make the purchase.
I don't think this document outlines it too much.
Yeah, I was curious if it was floating for like 18 months with an extension period, or and I'll preface that with saying I've done it before too, and we'll never do a bridge loan again. And that's why I'm curious.
Yeah. I think this was it was either a 2 or 3 year bridge loan with 2 1-year extension options.
With the floating rate, that was
floating rate
X
throughout.
over prime or whatever.
Yeah, it was LIBOR at the time, and
Okay.
so it was something like 350 or so over LIBOR.
Okay, cool. Thank you.
Yeah, and I agree with you. I mean, we've learned our lessons as well, and we've been successful with bridge loans, and also we've dealt with the pain and struggle of having bridge loans as we've experienced with the most recent unprecedented rise in interest rates. So that's been tough, and definitely I like fixed rates a lot, and we've been exclusively doing fixed rates lately. So I think that's a big win and a nice iteration for our business, because fixed rates may not necessarily produce the highest returns, because it might make you miss out on reducing on interest rates going lower, which they will at some point. And also it might reduce your flexibility to exit. It might incur higher prepayment penalties. At the end of the day, I'm okay with giving up those higher returns for more stability and certainty for our investors. So that's a quick fixed rate aside there. So no problem. So we were originally attracted to the Bear Creek submarket, and we actually continue to own in this submarket. We own 2 properties right near this one. We own Timberwalk and Madison at Bear Creek right down the street. So we continue to be very bullish on Bear Creek. We really like this little pocket of Houston, and that's because the median incomes are quite strong for workforce housing, and you have just this nice pocket of B class-ish, C+ assets that are 80s vintage, and they have a pretty stable tenant base where we don't really have problems with crime, and we don't have problems with turnover and collections. So it's a great stable pocket, and the rent growth has been very strong, and occupancy is really strong. So back at the time when we acquired this property, it was one of Houston's hottest performing submarkets, and it had a 6.7% growth rate in occupancy, almost 6% growth rate in rents. And those numbers have continued to be really strong, and I believe will continue to be strong in this pocket, which is why we are super excited to have more deals here. So as I mentioned before, the business plan on this deal was they really didn't have a full-time manager overseeing the deal. They kind of had a scattered site approach and lack of oversight. So us bringing professional management to this deal, we knew would really change the game for this property, because there's no reason for it to be underperforming the way it was. And then I already explained all of this, but this is really what created the opportunity, but then also at the same time created the challenge that we saw in terms of raising capital. And that reminds me, which I think is an interesting and worthwhile digression, which is the 4 quadrants of investing. And so you have, I'm not sure how well I can do this visually, but you have on one side of the quadrant, you have consensus investments, and then the other side, you have non-consensus investments. And then on the top, you have good outcome, and in the bottom, you have bad outcome, right? And so if you have a consensus investment with a good outcome, you're going to get an okay deal, because the fact that it was a consensus deal, you're going to pay a lot of money for it. And then if it's a good outcome, you paid a lot of money for it, so it works out fine, right? And everyone's going to be happy and everything's great, but it's not like a home run. If you have a consensus deal, right, you buy in Dallas in a great location and you buy a value add deal, but the deal doesn't go well, you'll probably be okay, and your investors won't be mad at you that much, because it was a consensus buy. It's not like you lured your investors into some wacky deal and it's all your fault for convincing them to buy, some sort of non-consensus deal, right? Like a conversion play or something like that, or a tertiary market. So then on the non-consensus side of things, which this deal in its own way slightly fell into somewhat of a non-consensus bucket. If the deal goes well, you do really well. Because it was a non-consensus deal, you're able to buy it at a discount, similar to what we had here. And then when it goes well, because you bought a discount, the deal does really well. However, when you have a non-consensus deal and the deal goes poorly, that's exactly what happens. What I mentioned is your investors are going to be much more upset at you. So as a sponsor, it's very risky to do non-consensus deals because if they don't go well, they hurt your reputation much more than failing on a consensus deal. The benefit of failing on a non-consensus deal is you bought it for a discount, so the failure is not as pronounced. So anyway, I've mentioned that quadrant before, and I actually got that from a really great book, which is Investing in Real Estate Private Equity by Sean Cook. That's just one of the best books for the industry, in my opinion. Okay, so here's just a little bit more about the business plan, renovating the interiors a little bit, doing some exterior work. We added a perimeter fencing because we recognized that was a big demand from residents to improve safety and enhance the perception of safety and community. So that was important. And then we upgraded some of the amenities. So we didn't do a ton, but it was definitely successful. So I think that's pretty much it on this case study that I want to share with you. I just wanted to walk through the case study itself and then also show the folders and everything. So I'll take a pause there. Hopefully we have some questions and then we can figure out where else we want to take this conversation. Okay, in the meantime, while I'm waiting for a question or two to come in, I'd like to show a cool new thing that we put together where we used to have our deal information not necessarily scattered, but they lived in all of our different folders for deals, right? And so if an investor reached out and they were doing due diligence on us and they'd say, hey, I'd like to see the last quarterly report for the last 3 deals that you bought or something like that, I would have to go into different folders and go and copy and drag them and save them and send them out. And so that was time consuming and didn't feel very optimized or professional on my end. So what we did is, quite simply, I created a folder called LSC Portfolio Investor Dropboxes. And then I just created aliases to all of the investor Dropboxes throughout our portfolio. And so you can see a deal like our most recent acquisition. Well, let's not do the most recent. Let's do 5 Oaks, for example. Click into this. This is an example of our investor Dropbox. So it mirrors, but it's similar to the case study folder, but it's different because this is an active deal. So we don't have a case study. And that's actually something I want to talk about in a second. But real quick, Scott in the chat is asking how much was paid for yield maintenance for the agency debt. So that's a fantastic question because obviously we took the precautionary measure of refinancing into agency during COVID. But then we exited the property not much later. So the reason why we were able to do that economically was actually we did a Freddie Mac floating rate loan on that refi. So because it was a floating rate loan, the exit fee was just simply 1% of the loan amount when we decided to sell the deal. So no yield maintenance was incurred. Okay, so looking at this investor Dropbox, this is the Dropbox folder that we provide every investor in a given deal. So investors in 5 Oaks, they reference this Dropbox and we update it monthly for the financials. So every single month we post the new financials for the previous month. And this is our accounting team puts together this full financial package, general ledgers, bank statements, rent rolls, everything. So our investors have full transparency into everything. And that we post in there on a monthly basis. And then we separately send an email out with just a monthly update saying, hey, here's the Dropbox link. And here's it's just some quick numbers about occupancy and performance and where we're at. We also have our LSC investor guide in every folder here. So this is just something for investors to reference as far as, hey, when can I expect my distributions? What is the communication expectation? What about tax documents? And it's just a nice little document, something new that we have implemented, and I think could still be improved further just to be more robust and provide more information, like a more full FAQ. So if anyone has recommendations on how to improve this, please just put in the chat or send me a note or something like that. Always looking to improve our materials.
Hey, Rob, quick question for you. On this deal, you mentioned that when you went in, it was at 80% occupancy. What specifically about the deal made you feel confident that you can take it up to whatever the stabilized vacancy rate was, if it's something specific?
It's nothing specific. It's just the fact that we analyzed the comps and we saw that they were at 94, 95, 96, 97% occupancy. And so we felt that this property didn't have any material deficiencies relative to its competitors as to why it should lag occupancy wise. So that was it. It wasn't, I don't think, any one thing that we fixed or identified.
Okay, thank you.
Cool. So just to wrap up on showing you the investor Dropbox, obviously the quarterly reports, the monthly financials live in the archive, the quarterly reports live in this archive, excuse me. And then also what's really important is the fact that the deal room, we called it deal room, we call it data room. We need to get it consistent. I like calling it data room. So the data room also lives in this investor Dropbox. So that way, every single month when an investor checks the financials, they check the quarterly report, they can also reference the data room, which has everything, all the documents related to the original investment. So we have debt information, the seller's financials that we use to underwrite and analyze the property. This includes the offering memorandum package from the brokers. We have, we just had some insurance information. We have our investment presentation, right? So that way investors can reference the pitch deck when they think about, hey, what did Lone Star say about the deal? Or, you know, what's the business plan again? They can reference this. And then of course, really importantly, referencing the underwriting, which I reference all the time. I'm always looking back and saying, okay, rents are here. Well, what did we say in the underwriting, and what were our projections and things like that. So that is really great to have super handy right here in the investor Dropbox. So what's really cool is we can really easily provide this level of due diligence to potential investors, right? You show, okay, here's the last few deals we've acquired. Here's the data room with the monthly financials, with the quarterly reports, all at their fingertips. And this will also, keeping track and being organized with all of this stuff from start to end, will help us to continue to create even better case studies. So that's, I'm super excited about that fact as well. So I'm going to take a pause there again, see if any questions come in. Otherwise, I'm pretty much wrapped up as far as what I wanted to share today. So let me know if you have any questions.
Hey, Rob, a quick question here. Well, first I want to say congrats on the new office and your book. I read it, good stuff. So when you're looking at deals in the market today and you're trying to stay away from bridge debt or kind of heavy lift risk in a deal, how are you managing the workaround when you're trying to leverage the deal? And a lot of deals these days are just kind of DSCR constrained, and so trying to get the right balance of equity and leverage in a deal. How are you looking at that?
Yeah, it's really tough. So because we are essentially limiting ourselves to only buying deals with agency debt, that makes our financing constraints limited. All right, so we can't get more leverage from a bridge loan, and what ends up happening is we have a very large equity requirement on the deal relative to, because the debt is lower leverage, right? Before, when DSCRs were less constrained, you could do 75% LTV, and now it's more like 60%, or even worse in many cases, especially if it's a value add deal. So to answer your question, firstly, we've been focusing more on stabilized deals because they have more in-place yield, right? The more stabilized a deal is, the higher the going in cap rate, which there's a trade-off, right? The higher the going in cap rate, that means there's less value at upside. And so you're kind of battling. You don't just get free better yield, right? So, but that's okay because we also want to generally be taking less risk in today's market. So by going for a deal that has higher going in yield, we can finance it better on permanent debt and we're taking less risk. But that only gets you so far, because even if you're buying a strong going in yield deal in today's market, that's still only somewhere around a 5% cap rate, which if you're buying a 5 cap and your debt costs you in the mid to high 5s like it does today, you just run the math on that and you're getting around 60-65% LTV, which is doable. I mean, that's what we've been doing, and just raising a ton more equity, and it is what it is. So that's kind of one answer. And then the second answer, which is unique to us and a really special opportunity that we have in Houston, is we are now focused on an affordable housing strategy where we are pursuing tax exemptions. And so these property tax exemptions are essentially contemplated and consummated prior to closing. And so the lender recognizes the program and is willing to finance on a post-property tax exemption basis. And that means if we're buying a 5 cap on a post-property tax exemption basis, we're actually buying a 6 or a 6.5 cap. And so when the lender underwrites the deal, they've got way more income to underwrite with, and they're able to provide much more leverage, 75-80% leverage. So that totally overcomes our leverage hurdle. But those deals are difficult to do, rare, not here to stay, and et cetera, et cetera. So it's great to be able to have a tool like this, but we can't, we recognize the fact that this market is otherwise very difficult to navigate.
Awesome, thank you.
Just
Hi, Rob.
just to go on.
Oh, I'm sorry. You can go
You
ahead.
go.
Oh,
No, you
thank
go.
you. Okay, can I go?
Yes,
Should I
go ahead.
Okay. Hi, my name is Vidhi Kochari. I'm a sophomore, so my question's probably going to be a little bit more amateur than other people's. But I was wondering, how did Lone Star leverage the properties below stabilized occupancy to their advantage in the sale process, despite most buyers seeking a stabilized value asset? So how did they execute their business plan to quickly stabilize the property?
Yeah, well, we quickly stabilized the property, just kind of what I mentioned earlier, which is just more aggressive marketing. We were putting flyers on the cars that were parked along the street. We were doing online marketing and advertising to just get more potential prospects, more prospects through the door. So no magic, but that's the beauty about this business, is there's no magic required unless you're talking about property tax exemptions. That's magic. So yeah, just good leasing, good marketing. And whenever you go into a deal with a bridge loan, regardless of the business plan, the goal is to get out as quickly as possible. And so we knew that at the time as well. And we were doing everything we could to stabilize the asset so that we could refi.
Thank you.
So the question I was going to ask, Rob, was just around the tax exemptions and affordable housing. Would you be able to just speak to that a little bit more? There's a couple of deals that I'm looking at in DFW, and I'd love to understand the process that you went through to kind of get that established and understand that.
Yeah, so DFW is tricky. I haven't figured that out yet. That's a lot more complicated from what I understand. So I can't help specifically on DFW. I know that there's just many more approvals required. There's a lot more bodies and organizations and people that you need to approve. But yeah, so that's tricky. So that's
with the general process, what does it look like? Because I'm inexperienced with the whole thing. I've not even done it in Houston. Do you know what I mean? So just understanding what that would look like going through in Houston, and I might be able to translate that across. Obviously, it might be more complicated or more difficult, but just any pointers would be great with it.
Yeah, we're doing a webinar on our portfolio offering next week where we'll be diving in more deep on this structure and sharing information on that deal. So feel free to check that out, where we'll be sharing more about that. But yeah, in short, basically, my business partner, Kent, he is a tax attorney, and so for the last 3 years, he's been working with different consultants, advisors, and lawyers, and networking with the Houston Housing Authority in particular. And so, yeah, it's taken us 3 years to build those right relationships where they trust you, because these programs are very not one-off, but they're bespoke and they're private. They don't necessarily they don't advertise them to the public, and so it's kind of, you got to get in, and then once you're in, you're more or less good. But that's been our struggle, to build the expertise and the relationships.
Okay, perfect. Thank you.
Hey, Rob, I've got a quick question for you here. As somebody that's new, I have capital syndicated, I have commitment from investors, but obviously it's kind of a crazy time to enter the multifamily syndication game right now. Any advice that you could give me as far as finding deals, as well as kind of where you see things going in the next 2 to 3 years? Do you think prices are going to come down, or cap rates going to expand? Just any advice you could give to somebody that's new. I've read both your books. I have them both right here next to me. Would be greatly appreciated.
For sure. So yeah, it is a very tough time to get started. So there's kind of this classic question, right, where you could be in a strong market where the deals are more competitive, like how they were for the majority of the last while. And it's easier to raise capital in those environments, but the deals are tighter. Or you could be in a market like, let's say, the dream market, like 2012. 2012 was probably the best year for commercial real estate in history. But it was very difficult to raise money. And that's what we saw during COVID as well. And whether it was difficult to raise money or not during 2020, a lot of people, including ourselves, believed it to be difficult. So we didn't take those risks. So you can't have it both ways, right? And I guess to finish that point, in 2020, the deals were really attractive. You could have bought any deal and made a ton of money. So the question is, well, would you rather get started in a market where it's easier to raise money, but the deals are tougher? Or would you rather begin your career in an environment where there's more attractive deals out there, but it's harder to raise money? So that's certainly open for debate. But I would argue that it's better to start your career in a market where it's easier to raise money, because raising money is the really hard part. And right now we have a very funky market because it's hard to raise money and it's hard to raise deals. We're in a nobody's market. People are saying, is it a buyer's market, seller's market? We're in a bit of a nobody's market, just because there's a big gap between buyers and sellers. So that bid-ask gap, if you just look at transaction data is way down. So I'm not discouraging you to not do a deal, but it's kind of the same advice in any market, is especially when you're starting out, you have to make sure that whatever deal you do is the right deal. And more specifically, because it's your first deal, you have to make sure that it cash flows day one and that you can start providing distributions as quickly as possible. If you can close on a deal and a month later start providing monthly distributions, that is how you will grow the trust and size of your investor base as quickly as possible. And that's what you need. That's what you want. Because even if you have the home run deal of the century, if it doesn't cash flow for the first year, your investors are going to somewhat skeptically sit on the sideline until they see more tangible results from that deal. So I would say, Matt and I were talking about this earlier, as far as buying stabilized deals that have more yield, that are financeable with long-term debt. That's what you want to do, in my opinion, in any environment, and especially in today's environment, because if you were to try to find a really good deal, but it required a bridge loan, it's just going to be, and a big turnaround, it's just going to be so tough to raise the equity. And then even if you do succeed to raise the equity, it's going to be super tough to do your next deal, because those same investors will not likely reinvest with you until a year later after you've proven that other deal. So I would be looking for good stabilized yield plays.
For sure. Makes sense. Yeah, I just finished structuring debt and equity, and that was definitely something I underlined. It makes a ton of sense of getting quick cash flow back to your investors. So I appreciate that. Thank you.
No problem. No problem. Cool. Let's take a few more questions if there are any. If not, we can call it a day.
Hey, Rob, this is Melvin. I'll jump in here with a question. So on the affordable housing play for your next deal that's coming up, is that from an outlook standpoint for you guys in terms of what you're trying to acquire? Are those some of your core highlights of what you're looking to try to get under from a opportunistic standpoint, say the next 6 to 12 months?
It is. It is. There's also some bills proposed in the Texas House and Senate that are proposing to abolish the programs and change some things up. So with all that uncertainty, there's going to be a bit of a pause in the market. We can't reasonably put deals under contract under a certain premise when that premise might change, right? So I think that's going to cause a slowdown and a pause in the market. But yes, that is still going to be a focus for us until it's not, or until we kind of see some sort of all clear sign. And then additionally, we just closed our first deal in Dallas a couple of weeks ago. And so Dallas is a big initiative for us. And so we want to continue to focus on buying market rate deals in Dallas, right? With no tax exemptions or anything, just regular deals, conventional deals in Dallas, and then affordable deals in Houston. Those are our focuses for the next while.
Thanks for sharing.
Cool. Okay. All right. Well, I think I'll wrap it up here. Thanks everyone for jumping on and making it a great conversation.